Good evening, ladies and gentlemen. What a crazy week in the market it's been. We're going to be reviewing what happened this week, what could be going into next week, the bull, the bear case, and any catalytic events that could be propelling us up or down. However, before we get into the video, quick legal disclaimer. This is not financial trading advice. All risk that you take in the market is your own. By doing so, you take responsibility and sole responsibility for all trades you place and risk that you take on. Now, let's get into the video. So this week was crazy. We started off by rejecting off our 50 weekly moving average once and twice, going down to our 250, breaking both of them, followed by on Friday going straight up and away through both. So the moving averages haven't really been a key point of resistance or support. They kind of just been there for the past 3 months. So they are important, but they're not used as key resistance levels because we've basically went straight through them so many times. It's crazy. Let's start off with the bull scenario. So we had a nice push up through both moving averages this week, and now we need to see continuation to the 50 weekly and break it. The areas of resistance could be this base that we formed off of the first rejection, which is sitting right at 397.5. And once we get past that region and form what I would say I would like to see is a push up, kind of reject off that region, come down, find support that became resistance. Now that you've broken through it, it becomes support again, and then push up through the 50 weekly. If we see a straight push to the 50, I don't suspect that it would break on the first, but maybe the second touch. So for the bulls, it's a very, 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 very simple game. You need to get above the 50. We've been talking about this too. We're blue in the face. The 50 weekly is the final boss. You get above it. You get above 400. 400 is key because it was an area of previous resistance, and now you could hit your head, reject back down through the 50. You want to see 2 candle closes above the 50 weekly moving average. Once we do that, we're pretty much set for a higher high and continuation of the move higher. Now, if I was to long the market, I would not be trying to long the market until we get above the 50 weekly. Now, let me explain why. From here to the 50 is about 0.89. Or if you want to take it from here to 400, it's about 1%. I will gladly give up my 1% in order to confirm this move above the 50. So let's say we get above the 50. And our first major resistance probably at 400. If we close above the 50, we're pretty much going to break through that. 404, that's about 1%. So I'll lose out 1%, but confirm 1%. So I really didn't miss out. Break above 408, which would probably get there. That's 2%. And if we were to say that we're going to go all the way to a brand new bull market from breaking the 50 weekly, you'd be looking at 4.5%. Let's say we close below the 50 weekly, you're probably looking at maybe to this support region of 0.4. So a 4% to 0.4 risk ratio, that's pretty appetizing to me. Now, if I was to look at the bear side, we had a nice movement down on volume. And that is what was lacking from the bulls. You did not have 2 large volume candles on the push up. You had one on close on an OPEX. I basically say this is disqualified for one reason. It's OPEX. The market makers are not going to want to pay out the premium that was sitting at 380, 385, 390, and 395. Where did we close? 395.82. They closed it 0.82 above where they needed to close it to make sure that none of the premium got paid out. On top of, in the last hour, right here, you had all this volume. But the preceding 1-2 hours before and also the push previously, you never really exceeded the selling volume on the way down. You had pretty notable volume right here at this level, and you only really exceeded it over this one candle. To me, price is confirming the move, volume is not, which for the bears, it's great. You want the fish to swim upstream to you. Why are you going to try shorting support? If you short it here, you're near support. If you short it here, you're kind of still near support. Why am I going to give up try to fight the bull all the way up to the 50 weekly when I can just place my sell order right here at the 50 weekly and wait for the bull to come to me? Why is the bear going to go chase the fish when the fish is going to come swimming upstream to him? Again, pretty simple for the bears. You have to defend the 50 weekly and then close lower than this week. So you have to close below 395.82. And honestly, you want to take out on the weekly, the best case scenario is take out 387. I don't think we get there, but the previous week's close would probably be a good, or open with a good point at 390. A strong close below 390 would confirm the hanging man candle, which is what we have here on the weekly chart. This is referred to as hanging man candle because you have the rope that's coming up, the man's body, neck, hanging noose, and the body down here. So on top of an uptrend, this could show the signs of a reversal. We also reject off the 50 weekly. So what would be expected to see, not what we're going to get necessarily, is a candle below this here and continuation down. So it's pretty simple for the bears. Let the fish swim upstream to you, reject off the 50 again, creating new breakout traders, and then going lower. So if we look at the cues for a second to maybe confirm what we are seeing for the bears, you gotta prevent them from breaking this right shoulder right here. So we can't trade above 392 on the NASDAQ. We're pretty far away from that. That's about the top of the swing, 0.4% move. You need a pretty big push through the NASDAQ, and I would probably be looking at the S&P to reject off first off the 50 weekly before I got a 3% move versus S&P's 0.8 move that it needs to the moving average. So again, it's pretty clear cut, bear and bull. You got to get above the 50 or reject off the 50, and it's as clear cut as can be. It can't. Sometimes trading is simple. You got to get above the 50 or reject off the 50. Now, let's get into where I see, or trying to explain maybe the move that we had on SPY on the daily. So if you look in the hourly, you really didn't see, again, the volume. That's because you had OPEX expiration. They didn't want to pay the premium, 395, 390, and 385. It was a crap ton of premium sitting there. They didn't want to pay that out. If I have to pay $1 billion to save $10 billion, I'm going to pay the $1 billion every single day. There's no question about it. Now, what does that mean they have to do? They have to buy. But when you buy a stock, you can also sell it. So now these market makers can go and they can sell all the stock they want to the people that are trying to buy this market, and they're selling into strength. So for them, they're getting a nice return on investment. They're not going to send you completely lower to these levels down here. People are going to see this. You're going to create new breakout traders. You're going to want to push up higher to it. And you're going to see the key is going to be if they're holding that position or not. We should have a clean move up if they're holding that position, or you should see it being jagged over Monday and Tuesday, because there are not a lot of catalytic events coming out Monday or Tuesday to really spike the market one way or another. So I would love to see a jagged move up to this 50, meaning market sellers are selling, retail is buying, and usually, well, I'm not going to say usually, always retail is wrong. Big money has more money than you. It can move the market more, and therefore you want to follow what big money is doing. And we're going to get into that next. Bulls continue up, break the 50. Bears, let the fish swim upstream to you, reject, do not get above the swing point of 400, which is our previous week's right shoulder basically, and reject downwards. Now, where do I see the market going from here? We have big red volume that wasn't on the downside. We have green volume that was not able to completely buy back the sell-off. That's pretty bearish for me. We're going to see where this continues. Now, 50 weekly is pretty much the battleground that I'm going to be looking for. And let's take a look at the net speculative positions on S&P, which is what big money is doing. Big money is pretty much shorting the market. It's pretty cut and dry, guys. The big money is at 226,000 net speculative positions. This was as of January 20th. Now, this is when the data is released. This is not necessarily when they take these positions. So if we look back in history when 230 was, December 16th, what happened December 16th? It was the CPI print with the Federal Reserve meeting and the ECB right before the massive sell-off. Big money was shorting the market before that sell-off occurred. So they made huge profits on it. And when we started basing back down in December into January, they slowly took their positions off. And what we were looking for is them to reload. January timeframe, as we're going up, they're loading shorts. Now, once we reach the top, they're adding more shorts. So they're expecting a significant downside potential if they're adding short positions as they're moving up and as they're nearing a top. let's see what January 27th, end of this week, shows for that. If we continue to see big money adding short positions, we could expect a massive sell-off coming into the market. Probably if we're going to see a massive sell-off, these positions will be confirmed after the sell-off because the data will be received January 27th. And I'm suspecting that we're going to start the sell-off prior to that. What will be interesting to see is if we exceed 230 as a selling off point. So if we see it exceeding 230, that means they're expecting significant more downside. They're exposing themselves more, and we could see what happens with that. From that, we can look into the news for next week. So Monday, there's not really much. Same with Tuesday. We have services PMI. That may move the market slightly. PMI, depending on how the market takes it or how it comes in at. The good news, bad news, good news. Who knows at this point with the market? Wednesday, we have crude and nothing really much other than that. That's going to move the market. Now, Thursday, GDP, core PCE prices, and core durable goods. These are going to be our top three that we're going to be looking at, and along with initial jobless claims. Now, their expectation for initial jobless claims is 205, previous is 190. This is where I could actually see the market meeting. I could see they're starting to lower their expectations of what the jobless claim is going to be, and you could get a 200 where it's a slight miss, but it's not really much, or maybe 195. The market may react a little worse to that, but reality is starting to sink in with the jobless claims. They're not trying to make these crazy expectations anymore. GDP, we're expecting about a 0.5, 0.6 decrease from GDP from last quarter, still 2.6 positive, and that's going to be a crucial thing for the Federal Reserve because it opens them up for rate hikes. If you have positive GDP, you can be more aggressive with your rate hikes. If you have negative GDP, you really don't want to be hiking rates. So if they see GDP shrinking more than their targets, and you can find that in the summary of economic projections, you're going to want to contemplate what the Fed's going to contemplate, because if they see GDP shrinking and they're expecting it to shrink more in Q2 and Q3 of this year, then you could possibly see a massive rate hike, basically 50 basis points instead of 25 on the next meeting, and possibly 50 if their nominal target is about 5.5, 5.2. They really haven't said what their final target is. They're saying everyone's pretty much saying it's going to be north of 5%. But north of 5% could be 5%, 5.1, 5.2, 5.3, 5.5, 5.9 even. So we really have to see where that 5 point what lands. Then on Friday, big bad PCE. This is what the Federal Reserve uses as their metric for the market. They do not care about CPI. They do not care about PPI. PCE is what the Fed cares about. The expectation is 4.4%, down 0.3 from last year-over-year's reading last month, and the month-over-month 0.3, slight increase. That's been pretty trending across all the inflation metrics that it's going to be a slight increase. Now, my warning to you guys is if you have not been at a gas station recently, I highly recommend going to a gas station to look at gas prices. Gas prices are going up. What do we know when gas prices go up? Inflation goes up. So on the next reading, not this one, I would suspect there to be an uptick in inflation, which could cause the market to react very poorly, the Federal Reserve to go ballistic in what they are expecting, because they fear inflation coming back more than anything in this world. Now, we're going to have to see what the expectations come in, what everyone's pricing in, but again, we go back to what the Fed has said this week. No rate cuts this year, higher for longer. That's been the message the Fed has been putting out. The market's still expecting rate cuts. So when we have our January 31st, February 1st meeting from the Fed, I do suspect that the market is going to have to reprice their expectations of what the Fed's going to do. And we've had this entire rally be built on rate cuts and lower tightening. The Fed has basically told you neither of them is happening. So every Fed pivot that everyone's been calling a pivot has been signified by the 2-year and the federal funds rate crossing. So if you look at the 2-year, it's kind of been forming a base right around 4.1%, and the federal funds rate's right at 4.1 as well. So they're coming close to one another. This signifies when the Fed is may be going to pivot. We usually see these two cross, then the Fed pivots maybe a couple months later. So the true Fed pivot, where they basically start cutting rates, may be a couple months out, maybe Q3, Q4 of this year, where there's a possibility. However, any rhetoric that causes to be hawkish from the Fed could see the 2-year basically blast off away from this line and significantly more downside for the market. So you want to see a convincing cross of these two. You want to see the 2-year fall below the 4.1% range. On top of, if we're going to see a 50 basis point hike, this number is probably going to go up significantly, pricing in something that wasn't expected. So we have to be cautious of what this is telling us. So with that, guys, leave a comment down below. Let me know if you want more of these type of videos. We're going to try doing a weekly video on the market to kind of give what's happening during the week, where we saw during the week, where we'll be going from here. If you like that, let us know, and hit the like button, subscribe so you can stay notified of all the videos we post. And with that, I bid you adieu.